Discover your learning options at the Institute for Mergers, Acquisitions, and Alliances. We understand that each professional has unique needs. That's why we offer flexible learning options designed to help you achieve your goals while accommodating your busy lifestyle. Select from our comprehensive M&A certification programs and decide when, where, and in which format you would like to participate in. Our on-site classes deliver an immersive and intensive learning experience in different locations across the globe. Connect and network with fellow professionals while strengthening cross-cultural understanding and broadening your perspective. Prefer studying from your office or home? Our virtual live classes provide the same high-quality instruction and interaction, all in a convenient and accessible format. Short on time? No worries. Our online self-study classes are accessible 24/7, allowing you to earn your certification at your own pace. Whichever you choose, you'll be joining a global network of professionals committed to excellence. Choose IMAA and elevate your career in mergers and acquisitions. The webinar is about to begin. Please stand by.
Hello, everyone. Good morning, good afternoon, or good evening to all of you joining us today from wherever you are in the world. I believe we've got quite a global audience today, which is fantastic. Welcome to today's webinar, The Biggest Mistakes of Private Company Valuations 2024. It's great to see both familiar and new faces joining us today. If you're here with us for the very first time, allow me to give a brief introduction on IMAA and this webinar. So we are the Institute for Mergers, Acquisitions and Alliances, or IMAA. We are a global not-for-profit think tank in mergers and acquisitions and the leading institution in M&A certification, trainings and executive education. My name is Tom Allen. I'm the Chief Education Officer here at IMAA, and it's my pleasure to welcome you all here today. Before we dive into today's topic, I'd like to mention that we'll have a Q&A session at the end of the presentation. So we encourage you to note down any questions you might have during the webinar so that these can be addressed later on. It's worth noting that the chat is available for everyone, so please send us your questions via the chat facility, and we will have experts from Valutico and the IMAA team as well on standby to address these questions later on. In terms of today's topic, we're going to be discussing an area where even experienced M&A professionals can stumble at times, that being private company valuations. Now, as Warren Buffett says, it's good to learn from your mistakes, but it's better to learn from other people's mistakes. So on that note, we will talk today about how you can steer clear of the most common valuation missteps. To discuss further, we have invited experts from Valutico, led by their founder and CEO Paul Resch. Paul is a corporate finance expert with experience in M&A at Deutsche Bank. He founded Valutico in 2017 and has since grown the venture to what is now the world's leading business valuation software. So with that, hello, Paul, and over to you.
Hi, Tom. Thank you very much for having us today. I hope everybody can hear me well. Looks like it. Right. Okay. Well, you already made the introduction. Just very briefly, what we want to talk about today. I have the honor to introduce also my guest speaker in a minute. Then we'll go through sort of the meat of today's presentation, the top mistakes in valuations. And then we'll also give you a very short demonstration of the Valutico platform so that hopefully you don't even have a chance to make any mistakes. That's even better than learning from other people's mistakes, I would say. And of course, a short Q&A session in the end. I'm joined today by I would say guest of honor, Steve Shaw. You can see the facts here on the slide. What you don't see on the slide is that Steve Shaw is easily the most interesting person in valuations. He is, as I know now, a very good guitar player too. I hope one day in one of these webinars we'll actually get to hear a little jam session. Steve has trained many generations of valuation leaders across the world in many countries. Former partner at KPMG, runs his own training firm today. And if you're ever in need of further valuation training, I couldn't recommend Steve more. We've been working with him for many years. He's been a great supporter of Valutico and also a client for many years. Steve, I hope you can hear us. Welcome. Do we have Steve? Maybe if we could. Well, I'll continue with the introduction. I'll add a few words about Valutico. And I'll keep that brief. Oh, here you are. Hi, Steve.
Good day, everybody. Good day. Thank you for that, Paul.
Great, and thank you for joining once again. Always a pleasure to host these sessions with you. Yeah, just Likewise. A few words about. Thank you. A few words about Valutico itself. We are today present in over 90 countries globally, around 750 clients, a team of closer to 70 people now. What isn't on the slide is that we have helped valuation practitioners to do 20,000 valuations over the last years, with almost 10,000 added every year now. So that sort of pace is accelerating. And you can see, if you see so many valuations on the platform, there's a thing or two you can learn from what people do. And that, of course, also improves valuations for everybody in the future on the platform. Just a few examples we work with. We like big clients, we like small clients. Many of the leading banks here in Europe, many of the leading professional services organizations all around the world. You see Deloitte, for example, here, another one of the big four to be added shortly. And overall, I'd say out of the top 20 professional services networks we work with, I think probably 3/4 now today. Many of the leading M&A networks, of course, even more relevant to you. hopefully also soon we'll be able to work with you. Okay, I promise to keep it brief. Steve, shall we jump into the 10 most common mistakes?
Yes. We've got to go quite quickly because we've got 10 topics to get through. So we'll start off with debt assumptions, and I'm going to talk more about the debt level, and I'll let Paul come in about cost of debt if he wants to later on. But I think the major thing with debt level, they're both market. So you're looking at the projected debt level in the future, which means that whatever happens today is not that relevant. It's what a market participant would do in terms of financing, what sort of D over E they would come with. And the one thing we don't do is read debt and equity off the balance sheet. I know it's quite tempting, but really the debt should be at market value, the equity should be at market value. And the best way to gauge this is to look at the peer group, a benchmark, to comps as they're called, to see what their debt and equity is. Actually, one of the issues of let's say, owner-managed businesses is that they often don't have any debt at all, partly because they don't want to be controlled by bankers, partly because they're a little bit more conservative. Now, if you were going to be selling to a market participant who was another owner-managed business, you might say, well, actually, perhaps that buyer wouldn't have any debt either. But more often, we think that they might sell to a trade buyer, and even if they've not got any debt at the moment, a trade buyer would actually gear up at a normal level of leverage. So basically, different buyers or different prospective buyers are going to have different levels of leverage depending on their appetite for debt. But the major takeaway for me is that actually there's market values, so we can't really record them. We can actually only look at peers. Paul, have you got anything to add to that?
Not much to add to that. I mean, just what that always perplexed me in the beginning of my career, right? That there's something that that it can be ideal for a company to add debt, right, to its balance sheet, right, to optimize its capital structure. I mean, in an ideal world without taxes, it wouldn't have an impact, but there is the thing called a tax shield, right?
Yep.
So it can be optimal to add some debt to your capital structure, right? And obviously, in the normal valuation, you're basically assuming, right, that you would have an optimal capital structure. Right?
Well, you're assuming that the peer groups will, yes, that hopefully the listed peer groups. And basically you talk about the tax shield. If there's only the tax shield, everyone would gear up 100%. But then you have the cost of financial distress, which is the valve, if you like, that brings it back down to a normal level, which is why we get this smile of leverage versus WACC, which goes highly up after about 30 or 40%.
Mm-hmm. So we have it here even as a point, right? The probability of default sort of goes up, right? And that's why you get this U-shaped curve. Yeah. Mm-hmm. Maybe one thing to add, we haven't talked about it yet, ignoring contingent liabilities, off-balance sheet debt, also something you see sometimes with private companies, maybe in the form of guarantees, right? That the owner of the company bank guarantees, for example, right? A very common thing. And that obviously should be reflected.
Well, that's going to be reflected in the amount you take off, isn't it? Because if you do an enterprise value, you've got to have an amount you take off, and that's absolutely right. And don't forget derivatives as well, if there are any, but there's not usually very many with smaller companies.
Yep. Very good.
Okay, I'll hand over to you, Paul.
Thank you. A related topic, I would say, excess cash versus operating cash, right? Debt is the one thing you usually have in your net debt bridge, as they call it. Cash is the other thing, right? So when you get from enterprise value to equity value, you typically also include excess cash. Now, the definition of excess cash isn't always easy, right? The simple thing would be to just include all the cash as excess cash in your net debt bridge, and most people would do that, including myself, right? In many situations. But if you want to do it absolutely correctly, you have to calculate the actual cash requirement that the company has. You called it the lubricant here, the car oil, right? There is a certain level of cash that the business needs in order to operate, right? In retail businesses, that's just the cash that's in the sort of the machines, right? But even in other industries, cyclical industries, for example, right, where you always want a certain level of cash because you have seasonality, right? It doesn't just matter the cash balance at the end of the year, right? You also want to cover sort of intra-years lows in cash. Anything to add to that, maybe?
Yes, I mean, what I tend to do with excess cash is you look at the cash balances perhaps at the end of each quarter, And then you ask yourself, well, okay, how much you want to keep in the business, which is going to be working capital, which can't come out. And then if there's anything that is excess, then that can come out, and that's basically added to the value at the end of it. But as you say, it's the oil that in the car engine. You can't take that out because everything will grind to a halt otherwise.
Right.
And there's one other thing as well, is that tech companies tend to hold a lot of cash, and a lot of that is actually to do with the financing of intangibles in case they have a problem. Because if they have a problem, they're not going to be able to get finance from anywhere. So they need a certain sort of reserve oxygen supply to keep people's noses above water. So those are sort of the tech companies will tend to have a higher cash requirement, and you can benchmark that than many operating companies.
That's a really interesting point, by the way. I run a tech company myself, but that has I've never even thought about that.
You need some cash. You need some cash, Paul.
But you always need cash. Huh? We're not a Facebook yet or a Google, right?
Yeah.
But true. Very good. Let's move on to the next one.
Okay, well, connected to cash, of course, is working capital. And when we talk about debt, just going back to that, anything that has interest attaching to it or that unwinds, like a discount, for example, for long-term reinstatements, anything that has interest is called debt. And of course, anything that doesn't have interest would be liabilities, which should be included in working capital. But the big issue at the terminal period is you get there's two stages. You've got the explicit forecast period, and then you move on to the terminal period, and that terminal period is a different system. And when you have two systems that sort of hinging together, that's where you find the errors. It's the interaction between the end of the explicit forecast period and the terminal period. And what we would tend to do with working capital is perhaps actually take that forward 1 year. I tend to like to do that 1 year more. Because remember, naive working capital actually is an increase in working capital. So it's a derivative. It's not actually the working capital itself, but it can be easily forecast on the balance sheet. So make sure you actually run through the process of forecasting it through the balance sheet. And if you like depreciation and capex, that's a derivative of fixed assets. It's the increase in fixed assets, which perhaps you need to be quite careful about, especially when you have a company which is heavily, capital intensity, a lot of fixed assets to sales. And in that situation, you might very well look at two little models. One is called return on new invested capital, and the other would be actually unpacking the terminal period. So if you've got a lot of fixed assets, that's an area which can get you into a bit of a mess, because otherwise if you run the cash flows forward, you're assuming that all the capex and the depreciation is at the same level of sales. And actually, if you run it through the terminal period, you end up running out of fixed assets, which is not a great assumption to make.
Mm-hmm. Was it the McKinsey model that basically mathematically shows the relationship between return on net invested newly invested capital, growth, reinvestment rate? Yeah.
Yes, that's where I got it from, about 15 years ago, and it was quite an eye-opener, actually. And it's a very easy model to run, and it tells if you've got a problem. And if you've got a big problem, then it's worth putting resources to it and doing some more work on the cash flows. Yeah,
I mean, that is something I've consistently seen people do wrong, right? These sort of assumptions in the terminal year. I myself did that wrong myself, right? The first couple of years of my career, but nobody ever told me. But I think it's one of the the biggest mistakes you can make, actually, right? Sort of underinvestment in the terminal year, or even overinvestment.
And remember, the terminal year figures of cash flows are often multiplied by a factor of 10, because that's the discount factor for the annuity. So, and given that 80% of the value might come from the terminal year, it's worth putting a bit of effort into that.
Yeah. So for the audience, without going into all the technical details, have a look at the McKinsey model for this RONIC, terminal year, and terminal year growth and reinvestment rate. Very good investment of your time if you want to make your valuations more robust, more defensible. Okay. Poor choice of comparators for betas and multiples. So that's one of my favorite ones, because that's something that Valutico, I think, does particularly well recently. Obviously, a lot of what you do in valuations is driven by what you compare against, right? Valuation, in essence, is comparison. right? Whether that's multiples, but also DCF-based approaches, right? You're essentially comparing against the alternative investment. So it's really, really important that you find the right peer group, you find the right, transactions also, in order to come up with good assumptions for, multiples and betas. I mean, the easy thing to avoid is by just looking at the value drivers, right? You want to have companies that grow in a comparable way, that have similar levels of profitability, of capital intensity, but also of risk, right? As expressed by the beta factor. One other thing is look at R-squares, right, of your correlation analysis for beta calculations. If you see, I mean, R-squares are usually very low. There's, little correlation typically. We all know the CAPM is a rather weak econometric model. But do look at R-squares, right? And if they're extremely low, consider, excluding certain peers, at least from your beta calculation. Anything to
basically,
add?
I have a threshold of somewhere around 7 or 8% is not going to be statistically significant. Therefore, if it's above that, you can just about bring it in. But R-squareds, I mean, basically, it's the CAPM is a bit like a hammer when you need a screwdriver. It's not quite right. But if a hammer is all you've got, then you've got to go with it. Yeah. I would also ask questions for those of you who are working internationally. Be careful about what market you regress your betas against. You do have a choice. You can regress them locally, or you can regress them against the US, and various things like that, which do make a big difference. And then also when you're doing comparables, you might not have direct comparables. An example I often give is Rolls-Royce. Rolls-Royce make aero engines. There are only two other makers of aero engines in the world, which is Pratt & Whitney, which is part of United Technologies, and General Electric. And you're not going to be able to get comparables from these guys because they're part of big multinationals. So you then may have to go to Boeing or Airbus to say, well, okay, those are going to be the main risks. But there's still going to be a bit of a gap between what you've measured and what you're trying to measure. You can also go for business type, which is where United Technologies is actually quite interesting because they own a company called Otis. And Otis also have their business in the same way as aero engines, which means they put the lift in for free, and then they actually live off the service income from it, and they do all their own maintenance, of course, because they don't want other people maintaining it. Mm-hmm. So there's a few things you can do there, but it always comes with a health warning, do betas, and as does the CAPM.
Steve, in a situation where it's difficult to find the right comparison, would you go for a larger peer group or a smaller one of really comparable ones?
Yes, I mean, I think I do tend to weight them, actually, look at the R-squared and say, okay, well, these ones are hot because they're connected to the CAPM, and these ones which are a bit weak, even though they might be actually quite close, you can weight them in a number of ways. You don't just have to take a median or an average. But it is very much a sort of, finger in the mouth, a bit of an art form or a craft. You've been given a certain amount of raw materials, and you've got to make the best of them. I think that's the major thing there.
Right. Okay. Next one. Enterprise value.
Right. This is one of my favorites because this is where I get to insult everybody. Because it sounds so easy. The right hand side of the balance sheet is just debt and equity. But what is debt? It's not just long-term debt. There's got to be overdrafts and revolving facilities there. There may be, if you have convertibles, there is a debt portion of convertibles as well. And then you start looking at other types of debt, which are preference shares, for example, which are debt which is not tax deductible. You then have things like leases. If anyone's been dealing with IFRS 16 over the last few years, that's put an amazing amount of debt onto the balance sheet because there's a right of use asset on the left-hand side. On the right-hand side, there's a lease obligation. And there are also these things for those of you who have long-term liabilities. You have these things called asset reinstatement obligations, like an oil rig that has to be pulled out of the sea and the ocean crust patched up. That's something which will then also be called debt because it's going to reverse. And then let's not forget pensions as well. Sorry, nuclear. Yeah.
Nuclear. I did a project once on nuclear with a nuclear power plant. Same situation, right? You had to add the reconstruction cost. Not that most of us value oil rigs or nuclear power plants.
No, it's a smaller one. But also remember about pensions. I mean, that pensions, if there are any defined benefit schemes on your balance sheet, I say this is for mergers and acquisitions as well. If you're looking at acquiring a company and it's got a defined benefit on the balance sheet, call an actuary. I mean, you need help there because it could blow the whole deal out of the water. I've seen a lot of deals blown with that, but it is debt. So, you have a protected benefit obligation which you have to pay to your pensioners, and that's a debt that unwinds. So that's, Anything to add there, Paul?
Maybe just the last point we have on the slide here, because I work a lot with different data sets. Even when you subscribe to, providers of M&A transaction data, very often you see that even they confuse it, or maybe they don't have enough information, right, frankly. So outside in calculating, an enterprise value so that you can then calculate an EBIT multiple, right, or whatever, EBITDA multiple, not as straightforward, right? You need a lot of information. So what a lot of these providers do is they use the enterprise value or the equity value the same way because they have no information, right? So it's just something to be also careful about. I tend to use, a larger number of transactions when I calculate that. So hoping that maybe the median fixes some of my problems, right? That the problems average out, but definitely something to pay attention to. Good. Inconsistencies in cash flow assumptions. Well, that's probably the number one problem. Also relating to the NAV assumptions in the terminal year we mentioned earlier. You see a lot of hockey sticks in valuations, right? I do some startup valuations every now and then. I'd say it's almost the norm, right, that you see hockey sticks in these. And that's something you have to be very, very careful about, right? You have to have consistent assumptions between, say, growth and investments. We mentioned the Tesla example here, right? I remember the case where a famous equity analyst projected Tesla growth, but forgot to include capex, right? You need to build factories, right, if you want to build cars. That might be an extreme case, but things like this happen all the time, right? Growth usually costs money, and that needs to be reflected somewhere.
I can add to that. I mean, you're bound to be given a hockey stick in a startup, but the job you have to do is then ask the questions of how you flatten it out, because that hockey stick, it's easy to grow when you're small, but when you get to a certain size, you're going to flatten out, and within a few years, you're going to be growing at probably not much more than inflation. Maybe 10 years, but it's still going to flatten out, because otherwise you're going to have 120% of the market share by next Tuesday, which is not going to be a possibility. The other thing I would say with the cyclical industries, for example, is that you might be better, rather than doing the terminal value, just one figure, which has to be an average, of actually doing 4 or 5 cycles instead of doing the terminal period, because it's going to pick up most of the terminal period, and it picks up that sort of that cyclical element, which is important. And
if you can't, maybe pick the terminal year somewhere half in the cycle, right?
You might average it, actually. That's one way of doing it. Yes.
Yeah. Can you think of examples of industries that have high cyclicality?
Well, you think of steel and think of commodities industries, for example.
Yeah. Construction.
And it's interesting, actually. People say, well, why don't you ever see cash flows going up and down? And actually, you often don't. And but everyone's got a cycle, but that's actually covered by the market risk premium. That's one of the things that the market risk premium is basically saying, look, there's no way we can forecast a cycle, because Paul and I would be on a beach somewhere in the Caribbean at the moment if we could. But the market risk premium is something that helps you with that. I'm sure you wouldn't want to be on a beach with me, Paul, but I was just
bring your guitar.
Yeah, exactly.
But that I just thought about that. So you would probably see higher betas for more cyclical companies. That makes sense.
Quite often the cyclical companies, especially if they're commodities companies, you actually may be looking at factor analysis, where you're actually linking it to the price of copper, or actually the commodity itself, because these companies, like oil companies, are actually notoriously weak with R squared, and they're notoriously not that well connected to to the CAPM. Thankfully, small businesses don't tend to be cyclical because they wouldn't last to the next cycle.
Yeah.
But certainly, larger businesses, you may very well look at the underlying commodity rather than the actual cash flows or the risk on a beta, for example, using beta.
Right. Okay. Next one, tax issues.
Tax. Oh gosh. Well, any of you who used to be auditors or accountants probably thought, well, now I'm doing valuation, I'm doing M&A, I don't have to do anything on deferred taxes anymore. Well, I've got bad news for you, because deferred taxes are actually the movements on deferred taxes give you the cash taxes. And remember, when we're doing cash flows, we want the cash taxes. So we make certain assumptions in the cash flows, and they would be what we would call the expected tax rates. And those tax rates would be basically cash tax rates rather than the statutory rates. And so most companies don't pay anywhere close to the statutory amounts of corporation tax, because we all have investments. It's accelerated depreciation. Now, a lot of the time it doesn't make much difference. But if you have very high deferred tax balances, actually, when you're actually doing the deal, or your fixed assets are much reduced from what they were or should be, sometimes you have lower than average, and perhaps you have a very long explicit forecast period, I think then it's worth tracking the deferred taxes so that you actually get the taxes, the adjusted taxes, if you like, and that gives you a better idea. Now, when it comes to discount rates, don't bother. Because you can run different tax rates every year, and you can do that through the cash flows. But if you do that through the discount rate, you'll have a different discount rate every year. And I can tell you, it basically gives you about 0.5% difference. So it's not worth it. Just you're wasting your time, really. So don't bother putting them. Just put a statutory rate into the cash flow. Into the discount rate. And then finally, terminal period. We should expect to go back towards the statutory rate as the company slows down. So those are the major things that I've got.
One thing maybe I want to add about the what you just mentioned, recalculating cost of capital every year. We do find it quite useful in high growth companies in some situations. So there you can sometimes get materially different results, and some situations with interesting financing structures. I see the topic here of pre-tax versus post-tax valuations. I'm definitely not going there. I recommend you don't go there either unless you absolutely have to.
It's the German problem, isn't it?
Yes, absolutely. If anyone's interested, feel free to get in touch. Maybe I can help, but it's a topic I'd rather avoid.
I would say one thing, that when pre-tax and post-tax, if any of you doing any IAS 36 impairment tests, ignore when it says pre-tax, because that's just the fact that the standard was drafted rather badly. So where it says pre-tax, just go to post-tax. It shouldn't, because pre-tax doesn't make much sense. Sorry, Germans.
That is interesting. So you get away with using post-tax cost of capital.
Use post-tax, but then you disclose the pre-tax using a goal seek.
Yeah. Okay, that's good to know. I haven't done impairment testing in so long, but that's interesting. Okay, topic number 8, confusion about basis of value. Is it my turn or yours? I think it's my turn.
I think so.
Right. I mean, biggest mistake, not clearly defining what it is that you're actually calculating, right? Are you calculating an, IFRS fair value, or is it a, IDWS1 in Germany, or, a liquidation value or book value or whatever it is? There are many, many different definitions of the basis of value, right? And basically, by the way, also the levels of value. That's a concept you're familiar with. So do make sure you clarify that, by the way, before you even take on a valuation engagement. What is expected of you, because that can, it can lead to very, very different results. To give one example, going concern versus liquidation value, right? You can come to very, very different results. Even, we would also use different valuation methods, right? And those would produce very, very different results. Sorry, Steve, over to you. Yeah.
Okay, no, I've nothing really to add to that, except that the fair value is made up of different people's investment values, and everybody has a different investment value. I think we better start skating, actually, because we've got to leave something for other people. So double counting between beta and alpha. Just be careful with alpha, which is sometimes the firm-specific premium. This is really where the rubber meets the road, and it's very judgmental. But it basically means whatever's not been picked up by beta. That's why we sort of put them as two sides of the coin. So I think the major message I've got here is really there's always going to be some leakage between the two, but try and keep the specific firm for the stuff that you haven't picked up in the beta, because the beta does the heavy lifting, if you like. And we can often use size premiums and things like that. I would recommend the qualitative assessment in Valutico, because I think it's a great piece of kit. And it is consistent. It's not necessarily right, but we can't be right and wrong in this situation. But it's if it's consistent, it's the sort of thing that practitioners really sort of latch onto.
One thing to add, maybe, the common confusion between, or generally, how do you capture size, right? The classic size premium, right? And that the size premium is very often such a catch-all thing, right?
Yeah,
everything is included in size, right? Obviously, bigger companies have fewer of that risk, and so on, right? So if you do apply size premium, be careful what other premia you apply on top of that. You might be double counting.
Yeah, I always distrust size premiums, to be honest, because they're more they're causal. They're not causal. They're just correlations. And I prefer to go behind the causes of what's driving extra risk.
Yeah. Okay, got time for one more.
Yeah, I think so.
Choice and application of discounts and premia. That brings me back to what I mentioned earlier, levels of value. That's something that I'm very happy that this is slowly being introduced in valuation literature. All the new standards also include that concept, and it's basically the distinction of, are you valuing 100% of the company? You have control value, or are you valuing, just a minority stake, right? And is that minority stake marketable or non-marketable? Right? And between these three levels of values, you usually sort of translate with different discounts and premia, depending on which way you go, of course. Some of these concepts are often confused, but I do also see more clarity coming now as people talk about that more. But just again, make sure you know what you're valuing, right? Are you valuing the whole company or valuing one share, for example? Very, very different the types of discounts and premium you would apply.
I would just add that for the discount for lack of marketability and liquidity, I would put them as one thing. And they're often modeled as an American put option, which sounds more difficult than it is. And the discount for lack of control, it's all about how much oppression and lack of information there is for the smaller shareholder. If the smaller shareholder is being treated in exactly the same way as the majority shareholders, I would say that the discount for lack of control is minimal. And it's not the same as the control premium, by the way. Control premium is what you get for having 100%. This is a discount for the fact that you may only own 20%. You may be outvoted. Paul, I think we've outstayed our welcome by 1 minute. We need to get Greg up and running here, I think. Yes.
Greg, over to you. Steve, and thank you to the audience.
Pleasure, as always.
Feel free to post any questions you may have in the comment section, and we'll try to answer that during the presentation, during the demo.
Wonderful. I'm just sharing my screen very quickly. Firstly, very warm welcome to everybody. Really looking forward to showing you Valutico's business valuation platform. So far, we've obviously talked about theory, so mistakes, challenges, pain points. I'm here to talk about solutions. How can we solve some of those problems? So what I'm going to do is just spend the next 10 or 15 minutes introducing you to our platform. Some of you may have already seen a demo. So first and foremost, this is cloud-based, plug and play, extremely easy to use. When you log on, you're presented with 3 modules. You can value private companies, public companies, and here we have a resources center, which is a great starting point for some useful valuation metrics parameters. So what we've done here with Valutico is we've built out a very long, comprehensive list of industry sectors. Here it shows you how many peers we've got, and across the top we've got the key multiples, and hand in hand with that we've got transactions tab. So similar rules of engagement, all of the deals within the platform. This is obviously a high-level overview. Once we go into the main platform, we can take a closer inspection at both the peers and transactions. So let us begin. The first thing we need to do is give it a name. So I'm just going to call this one a test company. Next up, the premise behind the platform is quality in, quality out. So the more information you pop in about the company you're looking to value, so description, keywords, a few paragraphs, the better then results will obviously be. As you can see also here, we're already harnessing ChatGPT's Copilot. So the choice is yours. You can run it manually, or you can use ChatGPT. That just speeds things up, a bit more kind of intuitive. Next up for us, we've got the fundamentals of the valuation. So first and foremost, we need to pop in where the entity is based. This is a global platform, of course. You can value any company worldwide. Then we need to pop in industry sector. Let's do something a bit kind of interesting, contemporary. Perhaps we can value somebody in the independent power and renewable energy space. Next up, we need to pop in the last reported annual revenue figure. So in this instance, I'm going to go small here. I'm going to choose 4 million sterling. Just so you know, all of the major currency crosses are supported here. But again, I'm going to choose GBP. Next up, we need to select the maturity of the business. Our platform caters for the full cycle, life cycle here. I'm often asked, what does this mean? Does this have an impact on the valuation depending on which one we choose? It doesn't, but what it will do, the platform will recognize the best valuation methods that perhaps you ought to consider for doing a specific valuation. So you'll see at the end, there's a difference between obviously how we value a startup and perhaps a slightly more mature business. Next up, if you can think of one, you'll pop in a listed peer. That just helps the platform work out the comparable peers. Then you would choose the valuation date. I'm going to keep it for the present day. And then last but not least, you need to select the actual year end for the business. So that's pretty much it. Just finally, please select what type of valuation you're doing. Lots of choices here. Most people are doing obviously buy side, sell side mandates. I'm going to scroll very slowly so you can soak this up. I'm not going to read all of these out. As you can see, we've got a very comprehensive platform. It will tackle most forms of valuation. So in this instance, I'm going to choose a sell side mandate. That's pretty much it. And away we go. Any questions, please do pop them in the comments section and we will address those questions right at the very end for you. So the first stage in the process for us, which is loading up, is called our qualitative assessment. I'm guessing most of you, before you probably jump into the hard numbers, the financials, the projections, you're probably going to have a tea coffee with a business owner and you're going to try and work out the cost of equity premium and the liquidity discount. So we're just doing that. So again, you've got the ChatGPT function here. So what is this? Quite simply, you're uncovering some soft facts so you can work out your cost of equity premium and your discount to the trading multiples. So it's like a macro component of the business. So you're grading, assessing company size, positioning, market share, competition, management, quality. When this screen loads, everything is average, everything is equal. This is where you use your professional judgment. So if there's a supreme leadership team there at the helm, I'm going to move this to the highest tier. And as you can see, the risk, the premium, discount, they all decrease. So this takes a couple of minutes. You can do this independently yourself, of course, or better still, why not involve the business unit, the business owner in the conversation? It's a great engagement exercise. I'm often quizzed, what's big, what's small? Very simply, small is your classic SME, startup, young growth firm, business, a couple of million. Big would be like the biggest of the best, 300, 500 million. On the right-hand side, we've got the weighting system. So here you can change these depending on order of magnitude. Once you finish this exercise, you can manually override the premium and discount as well. A lot of people obviously have strong opinions about those. Let's say we're happy with the qualitative assessment. Next up for us, it's all about the numbers. One thing you'll find about the Valutico platform it's extremely agile, so we can use different business plans. We start off with our P&O plan, which in essence is the income statement, so what I call the bare essentials. Most people use our basic plan, which is the income statement, a couple more line items off the cash flow statement and balance sheet. However, some of you more seasoned professionals, you might be well using our advanced plan, which is called our free statement model. So here you've got the income statement, cash flow statement, and the balance sheet, etc. And then finally, I won't cover all of them, but then we start getting into fixed asset schedule, equity schedule, debt schedule, cash, and RCF. So how does this look in practice? So we would upload our Excel model into the platform. Let me show you how you would do this. In essence, we've got a separate export tab here. You would populate this. You can download our template and complete it automatically, or you can map your own models in our format. Then you go back, and then here on the top right, you would upload your Excel. Okay. Next up, you can obviously play around with the time frames. You can do a 3-year forecast, 5-year forecast, you can go out a full 10 years. Historically, we can upload 5 years worth of numbers. I'm sure a lot of you also do scenario management. So here we can upload, your base case, top case, worst case. So this gives you the option to upload more aggressive numbers, more conservative numbers, or something in the middle. Okay. In terms of the tabs at the top here, we're going to start off with the valuation tab here. So this is in essence a plausibility check of the business plan to make sure it's internally consistent. Paul and Steve were sometimes talking about if mistakes are made. This will help you better identify those mistakes. If there are any mistakes, the color will appear in red. So it's like, hey, take a look at this. Make sure this is right. So here we see the growth rates, the margins, investments, including reinvestment rates. We've got a value drive analysis, which focuses on assets, and return on cap employed. We also return to benchmarking. Here's one more kind of cursory look at all of the peers that we've kind of selected, and then quite simply you can select peers by country or Western Europe or the globe, or you can select your very own peer group as well. So here we see net sales growth, we see other operating expenses and margins, we see EBITDA margin, EBIT margin, and so forth, and D&A margin. After that, we move on to the net debt bridge. So here you'd pop in the firm's debt, pensions, cash, non-controlling interests, considerations. However, you also have the ability to add your own custom net debt line item, give it a name, give it a number. Last but not least, you may be interested to know one of our most recent updates or upgrades to the system. We've added the net asset value. We're a very collaborative organization with our clients. So if clients have suggestions, ideas for platform improvements or working functionality, I give the team credit here internally. We very quickly include that on the system. So that's pretty much the business plan. Next up, we're going to move on to the peer selection. So again, one of the biggest challenges, problems is trying to work out who the relevant peers are. The platform obviously produce a list of relevant peers. We give you 20 peers in total, but obviously the idea is you would filter through these peers, and then any peers you don't like, you'd remove from the equation. So rather from the original 20 list, you're probably going to be left with 5, 6, what I call hardcore peers. Okay, so you're probably definitely going to be spending the most amount of your time in this section. Okay, just as you can remove a peer, guess what? You can add additional peers by country, by industry, by full text search. Top tip, use the full text search. That will really drill down and find the most appropriate peers. At the top, we got benchmarking tab, which shows you sales growth and average EBITDA margin. And here you can identify any outliers. And also better still, you can hover over any of these peers and take a good profile look. We've got 53,000 peers in the system. All of them have the fundamentals, the description, product service line, and the website. And then also we provide the financials. Many of you will be wondering at this stage, where exactly do we get the market data from? Of course, it has to come from somewhere. So we've partnered up for a very long time, well, since day one really, with a very reputable world-leading organization called S&P Capital IQ. I'm sure many of you recognize Cap IQ. S&P is obviously Standard & Poor's. This is their flagship market data suite. They've got this data embedded in our platform. So here we've got income statement, capitalization, valuation multiples, the balance sheet, capital structure, debt, credit spread, and the beta. Next up, we can also look at similar peers. So the platform does one more cursory sweep to see and ensure that we haven't missed any peers. And you can do a search by similarity of companies, analyst overlaps. Again, you can choose from ChatGPT selections or what other users have picked. We've literally got over 800 clients on our books, so people performing similar searches. Then obviously the platform kind of recognizes behavior and it will present the relevant results. Let's say we're happy with the peer selection. I'm going to move on to the business end of play. This is the transaction section. So in this section, we actually house all of our private company data. Okay, so you'll see list of deals by date, acquirer, targeted business, the standard stuff we know about, industry sector, and obviously stake acquired and deal values. And again, the whole idea really would be to vet the transactions. Any which are not applicable, don't make sense, you would remove from the equation. Big difference between this section and the peer section is actually you can add your own transactions. Many of you have probably got a library of deals. You probably have active subscription services. Obviously you rely on, you've built trust in. So don't ditch those. We'd actually actively encourage you to complement our existing system. Our system is in fact agnostic. So you can add transactions onto the system. This is the salient point. If you do choose to do that, just so you know, those transactions stay on your version of the platform. They're not for public consumption or public display. We've got some very sophisticated filters. So this will really help you drill down and find exactly what you're looking for. So again, our best friend here is the full text search. Again, you can search by industry, by country, clusters of country, Western Europe, the whole of Europe and the world. But then also we can go a bit deeper, search by bidding company, target company, by date. So you want to see the latest, most relevant transactions, available multiple, stake acquired, deal value, and company type. And we also have a number of different market database providers. Another one on our books is a company called EMIS. Not many people have heard of EMIS, strangely, but again, a very reputable database. These guys are great for emerging markets transactions as well. Just so you know, in total, collectively, we've got over 1.1 million transactions on our database. So just going back to the main section here, just to finish off, what else can you do? Each of these deals, you can review the transaction details. You can do a search by same buyer, show some of the transactions. A little bit push for time, but I think pretty much we've shown you most of the transaction section. I'm going to spend 1 minute on this. Some of you may be increasingly incorporating ESG criteria into your valuations. This is an optional stage. You don't have to use this every time, but if you're valuing a business in a dirty industry, so natural resources, logistics, plastics, perhaps, this is a quick fire questionnaire you'd undertake. You can share this with a client to complete. Every time you answer a question, an ESG score is produced. This will have an impact on the cost of capital allocation and discount rate. So if you'd like to learn a little bit more about our ESG capabilities, how you can incorporate that into your valuations, we can send you some literature and material. But actually, all things considered, we've actually finished a valuation. This is the end game. This is the stage where it really comes together. So far, we've only collected inputs. So we're just waiting to load. As a reminder, we call this one test company. Here we've got entity value or enterprise value. Some of you may prefer equity value. Now, by the way, I'm showing off here. I'm showing you every single valuation method on offer. Clearly, we wouldn't expect you to use all of these in one go. Most of you are probably using your standard staple 3 or 4 methods. So the first thing we need to do is really go to valuation methods, and then we would pick and choose which ones are relevant for that given valuation. To run you through the options, we've got the discounted cash flow WACC, the simplified version, adjusted present value. Now I'm going to start closing these down. I'm going to hide these. I don't want to use these. So I'm going to get rid of the capitalized earnings, cash flow based model, flow to equity, dividend discount model, various versions of capitalized earnings. Some of you may well also regularly do trading comp valuation. So I'm going to shut those just in case you haven't got the numbers, the forecasts. Then also we've got transaction comp. Interestingly, one that's automatically shut because we didn't go for the startup valuation option. We've got a VC method, which is particularly effective for valuing startups and loss-making businesses, and LBO. So I've got rid of all of those, and this is like a live working document. Everything gets updated. So there we go. The ones I've closed obviously now disappear. Now I'm expecting to see a valuation range which is a bit more kind of realistic. How to read this: the orange dot is the value of our business, which is based on this valuation methodology. The darker blue range is the peer group, and the grey range is the average of all of these. Next up, we've got the net debt bridge position, which we talked about earlier. Then we've got levels of value and adjustments. As Steve kind of mentioned, sometimes 100% of a business is valued differently than a 1% stake. So this talks about lack of control, lack of marketability. Then we've got, in essence, a flow chart showing you how our WACC has been calculated. So blue is showing you cost of equity, light blue cost of debt. Here in the middle, we've got the cost equity premium. You have complete control over the valuation, so you can override the valuation range. You can interchange between the various scenarios, and then anything on the right-hand side you can adjust. This is not a black box. Everything is fully source referenced, so you can take a look at the background calculations, look under the hood, under the bonnet for the definitions. They're all there. But most importantly, you can override these if you feel particularly strongly about any of these. After that, we give you each valuation method in a lot more granular detail, along with the sensitivities, the WACC, the perpetual growth rate. That's always good to know. As everybody can hopefully see, high grade, professional grade presentation has been produced in a fraction of the time. Most people, even if you had a very talented analyst, junior, associate doing this, this is going to take a good few days, maybe the best part of the week. And we've zipped through this, and we've done this again very, very quickly. So the whole idea of the platform really is to do 70-80% of the heavy lifting. Here we've got a finance mix, cash flows, credit metrics. Just to finish off, once we're done and we're happy, we will export here. We can export in Word or PowerPoint. Also, we can do it in multi-language. So just to cover the languages, obviously English clearly will be the functional language for many of you, but we can also do this in German, Spanish, French, Italian, Portuguese, Polish, and Dutch, just to show you how that deck may look like. So normal PowerPoint or Word doc, of course, which means you can fully edit it, add slides, remove slides, but more importantly, you can white label the deck as well. Just going to show you a few slides here. So here's the valuation overview, which we saw a little bit earlier on, net debt bridge. Again, very slick. We always give you an explanation, definition of all of this. However, again, feel free to edit this and add your own narrative. And right at the very end, we give you the source reference points. Very, very important, where the information come from, in case you're asked by the reader. We include a disclaimer. And then also we go as far as commenting, talking about the different valuation methods, the key characteristics, use cases. I always save the best to last. What you can also do, many of you will, of course, have your own existing template that you're comfortable with, you're happy with. So why not consider maybe uploading your template to our system? And I think you know where I'm going with this. This is a la carte. You can specifically pick out what data points you want to include in your valuation. So if you took a Sean to our qualitative assessment, for nice touch, may wish to include that, you'd copy and paste that placeholder on, I don't know, page 5 of your template, and that would instruct the platform to drop the data. So that's pretty much it. And then you would name it, save it, and then you come here, you've got your own template. That is pretty much me done. I think we've got 5 minutes left for some questions, Paul, and my details, I believe. Yeah, so if any of you enjoyed today's session, you'd like to learn more about us, or maybe you'd like to take another look at the demo, then please take a quick screenshot, or better still, use your QR code here and arrange a virtual meeting with me. Happy to kind of answer questions, tell you a little bit more about our commercial model, pricing, and see whether this may be a good fit for you. Thank you very much.
Thank you, Greg, for that overview. Really interesting to see the Valutico platform, and fantastic to see a modern approach to valuation. Certainly wish I'd had access to this when I was working in M&A. So we've got I think, a number of questions. I know we're very, very short on time. So I think we can open up the floor to questions in a moment. In the meantime, it's just worth mentioning we have a number of IMAA training events coming up over rest of Q3 into Q4. So I'd like to draw your attention first and foremost to the valuation training session we've got running 16th to 19th of September. So this is a virtual live, so online valuation training with Professor Damodaran. So if you are looking to upskill yourself in all areas of valuation, do please get in contact with us. With that, I'll hand over to the Valutico team just to cover off a couple of minutes of questions. So guys, over to you.
Okay. Well, I'll deal with one from a LinkedIn user. What factors most often lead to discrepancies between a company's perceived value and its actual market value? And I'm going to link that with one that Antonis has also asked about, the big mistakes when they mix strategic and financial comparables, because I think they're linked. A lot of times the company will, if a small company, the owner may very well have what's called a golf course evaluation, which would be probably highly inflated. It's his baby after all, or her baby. And so we have to be very careful in the way we explain that and actually show, perhaps using multiples that with the best will in the world, we can't give them the same price earnings multiple or EBITDA multiple than a listed company. And a lot of the discrepancies may be through quality of earnings. And there may be also some under-contributing assets sitting there, which might then bolster it. So there's a lot that can happen between looking at a value of a company and then actually the transaction happening. And then I might link to Antonis's question about what happens with strategic stuff. Well, there's two ways of handling strategic. First of all, strategic value is not fair value. So it's synergistic value, and it's an investment value of the buyer, which I think you've actually mentioned there. And the way I'd look at this would be actually that you may run some scenario analysis. If, for example, you were actually valuing from the standpoint of the seller. But if you're valuing from the standpoint of the owner, you say, well, actually, this strategic value, I don't really want to give that to the seller. And so you might do two valuations, one without the strategic, one with a strategic, and there's your negotiating surplus, if you like, between those elements there. Hope that's been quick, but I hope that's been useful for you.
Maybe I'll cover the other two that are open. First, I'll start with the shorter one. Camelia Fativa is asking, is it safer to buy independent companies or companies from another private equity firm? So only thing I want to say is private equity firms are usually very good at timing an exit really well and preparing a company for an exit. And they typically don't sell at the point where a company is sort of at the low of the cycle, right?
And they also don't like giving warranties and indemnities either, which is a major tool in your M&A tool basket. Yeah.
So I think if you want to find a rough diamond, I think it's more likely from an independent seller than from a private equity seller. Great question. The other one is also interesting. Angel P is asking, are there any red flags in financial statements that often lead to valuation errors? I mean, I can't think of red flags. I mean, I can think of many red flags, but what I would like to point on is what I would usually do with financial statements in private companies is that I would look at a sort of benchmarking analysis, right? Private companies are unique in the way that, for example, that the financial statements don't really reflect what's actually going on very often, right? You might have an owner who either pays himself or herself a very high salary or a very low salary, right? Or who employs family members, either a very high or very low salary, right? There might be the situation that I outlined earlier, bank guarantees, right? Maybe the company pays very low interest because there's a private guarantee from the owner, right? Which is not what would happen, right? If the company was independently owned. And a variety of other things like that, right? Real estate, for example, that's owned by the owner, but used by the company. So there's no sort of fair, arm's length transaction going on there. Any other examples, Steve? You can.
No, I'd agree with that. I mean, a lot of what you're talking about is maintainable earnings, and it could be maintainable because you're paying someone too little, too much. maybe discretionary costs as well, where people are spending more than they should be on like gold-plated engineering, we sometimes call it, where they're paying too much, and anyone else would come down and streamline and say you can only have this computer rather than this supercomputer that you've actually got on your desk at the moment.
I think we've covered all of them. If there are any more questions, feel free to reach out to us. Email addresses should be publicly available.
Yeah.
We're always there to help.
Yeah, so I think, well, yeah, thank you, Paul. Thank you, Greg. Thank you, Steve, for a really insightful chat this afternoon. Appreciate that we're running slightly over time, so I'll just try and wrap up as briefly as I can. So to all our attendees, we really appreciate your participation this afternoon and hope you found the session beneficial. I'm sure you did. If you'd like a copy of the presentation, please comment on the chat or send us an email at info@imaa-institute.org. We'd also like to announce that our training calendar is now available upon request. So if you are interested in any of our forthcoming training events, again, please email us info@imaa-institute.org to receive your copy. With that, thank you for joining us. Thank you to Paul, Steve, and Greg, and thanks very much.